Hello, I would like to welcome everybody today to our What's in Store for 2024. My name is Jackie Touche. I'm the financial advisor in Prince Rupert, and I'm also the wealth leader for Northern Savings. Today, we're going to have Jaime from Fidelity Investments be presenting our presentation today, looking at markets for 2024. Northern Savings Credit Union recognizes and acknowledges the First Nation traditional territories under which our service area falls. Northern Savings Credit Union's 4 branches operate in the following communities: Masset, Dajingites, Prince Rupert, and Terrace. Therefore, we acknowledge the traditional unceded lands of the Haida people and the traditional territories of the Tsimshian Nation. I would like to introduce my team that we work with in all of our branches. So in our Prince Rupert branch, myself and my assistant Amy are here, and we also have Tina Davenport as a financial services representative. And in our Terrace branch, we have Bailey Chasm and Tia Bear, and Tia also services the Haida Gwaii branches as well. The Financial Planning Department of Northern Savings, we provide many services for our members and clients, including retirement planning, insurance planning, education, tax planning, and estate planning. So I just wanted to introduce, give you a little bit of background on Jaime today. So Jaime has been in the investment industry for more than a decade, and she first got her start shortly after university when she began working as an assistant to a financial advisor in Victoria. She migrated over to Vancouver 9 years ago to work with the advisor team at Van City Credit Union. In 2016, she joined Fidelity as an associate and was quickly promoted to a senior business development manager. Today, Jaime is a district vice president of Fidelity Investments. She works closely with financial advisors across the province, providing market and industry insights to help them achieve their clients' goals. And Jaime, I'd like to thank you for being here with us today, and I'm going to pass it over to you.
Wonderful. Thank you for that lovely introduction, Jackie. So happy to be here on the line with everyone today to chat a little bit about markets, what happened last year, what we might expect this year. And at the end, we're also going to hopefully have a few minutes for everyone on the line to submit their questions as well. So I'm going to start sharing my screen here. We have a lot to get through in the next 30 minutes or so. So let me just see if we can get this going here. Okay. Bear with me, I'm just making sure we're gonna share the right screen. Okay, hopefully we can all see this presentation slide here. All right.
That's good, Jaime.
So, perfect, wonderful. Okay, let's dive in. So here's all the legal disclosure, don't do this at home, don't try this at home. So here's what we're gonna try and get through today. If we don't get through all of it, that's no problem. That just means that you can follow up with another chat with Jackie or your advisor, or maybe we can do another one of these webinars today as well. But I really want to walk you through just quickly who Fidelity is, in case some of you on the line might not be familiar with us. We're going to talk a little bit about the markets, what's happened, our outlook. Then we're going to move on to the cost of emotional investing, some tips on investing for success, and then why it's so important to have that trusted financial advisor who's on your team, who's working with you through your your financial journey. All right, so hopefully that sounds good to everyone. And again, I'll try and speed through some of this to get to the more juicy bits about the markets. So who is Fidelity? Well, we often like to talk about the 4 R's at Fidelity. So that's responsibility, our reach, our research, and our results. So Fidelity has been in the business of managing money for our clients, for individual investors, as well as institutional investors for over 70 years. And we're actually one of the largest money managers in the world. We're actually the largest private money manager in the world, which means that our company doesn't trade as a stock on any exchange, but we're privately owned. And I'll talk a little bit more about why that's beneficial in just a second. So our reach, we also have a huge presence as one of the largest money managers. So again, buying bonds, stocks, investment portfolios for investors. That means we really have incredible access to companies and policymakers and governments around the world, right? So really to leverage those insights into the research that we do, right? So our research is all proprietary, so we don't share our research on the street, but everything that we do, all the talks and the analysis that we do in terms of, you know, what securities, what stocks, what bonds we're going to buy for our investors, we do not share that research. So that is a huge competitive advantage for us. And, you know, all that translates into the results, right? What you care about as investors is the results that brings you to your investment statements, right? So just to put some of these things in perspective a little bit more. So Fidelity has offices and a presence all around the globe. So we have offices where we house our powerhouse of research. So our analysts, our industry experts, our economists located everywhere from Toronto, Vancouver, but all the way to London, Hong Kong, Tokyo, all around the globe, right? So when Fidelity is looking at, okay, are we going to purchase this stock or this bond for a client's portfolio, we want to make sure that we really understand that company, that security, and that we understand it within the context of where it is issued or listed, right? So we're not just looking through a computer screen trying to figure out, oh, what's this company over in Japan doing? No, we have analysts there that are making those decisions and talking with those companies. Another differentiating factor for Fidelity is how we pay our portfolio managers. So it is objectively based on their performance. And we tend to focus on, or we focus on the 3 and the 5 year performance versus our industry, so versus our peers, as well as versus our benchmark. So we're really trying to align our interests with the end unit investors. So that's a big differentiating factor. And then I mentioned that we are a privately managed company. Why is that important? Well, we're able to do what is best for our clients. Just like that last slide I showed you on how we pay our portfolio managers, right? It's based on performance. So if we were a publicly traded company, we wouldn't necessarily be able to have those kinds of those benefits. We would be managing our company based on, what's good for the short term, so what's good for the shareholders over quarter basis, rather than looking more long term and thinking, okay, what is again in best interest of the investor, right? How can we maybe invest a little bit more into R&D to help grow faster and at a more sustainable rate, right? So we really embrace innovation and encourage our team to go above and beyond. But again, how does that translate into results? Well, Fidelity, as a result of our research-driven, consistent, and thorough research process, we are able to offer a lot of investment solutions to investors, regardless of what your risk appetite is, right? So regardless of where you fall on that, on your risk tolerance, that we have a solution for you, right? So we have dozens of highly rated 4- and 5-star funds. And in case for those on the line who are not familiar with Morningstar, Morningstar is a third-party independent research agency that looks at different investment products across the Canadian investment landscape. So we are recognized as having one of the highest proportion of 4- and 5-star rated funds in the industry. So that is a super quick intro as to who Fidelity is. I think it's just important to kind of go over that, what sets us apart, before we dive into, again, some of the more juicy stuff, which is market data. Probably what everyone here on the line really wants to know about. So let's just dive right in. All right, so we can't talk about markets without talking about inflation. This has been an incredibly hot topic over the last year or so. I'm sure everyone on the line is very familiar with this story, not just in terms of seeing it in the headlines, but also personally, right? Who here is paying more at the pump, paying more at the grocery store, paying more at restaurants, right? So this inflation story is truly a global story. This is not something that's just isolated to Canada. And we can really trace this back in part to what happened during COVID, right? So we're a few years out of COVID now, but we of course saw that supply chain disruption that happened during COVID. That helped, push up prices, as well as all that pent up demand, right? So we had people emerging from lockdown and also wanting to get out there, wanting to do things again, wanting to go buy stuff, to travel. And so that all contributed to inflation. Also having a tight labor market, or in other words, full employment. So everybody out there who really wants a job can theoretically go out and buy it or can get a job. And so that also increases inflation, right? Because if people have a job, that means they're earning more money. And if there is a very small subset of people without a job, that means labor is in demand. And so employees can demand more money. And that means more money, which means the cost of wages goes up, which means the cost of goods goes up, right? So that all of that together has been increasing inflation. So what happens as a result of inflation? Well, you have an increase in monetary policy. Interest rates go up. Again, many of you here on the line are probably familiar with this story, because how many people have had to maybe renew their mortgages at a higher interest rate, or perhaps you've had to increase your rent payment, right? So interest rates have gone up. And why is this? Why have the Bank of Canada and the Fed and central banks around the world? We've seen a lot of interest rate hikes, and this is really an effort to slow down inflation, right? To slow down the economy, to lower economic activity. And that also means to, politicians don't want to say this because it's not popular, but also to increase unemployment, to take that pressure off of inflation, right? So what do we expect for this year in terms of Bank of Canada rate hikes? Well, we think we're at the peak of rate hikes. So the expectation is actually that both the Bank of Canada and the Fed will be cutting rates this year. Now, there's a debate over timing, but the more crucial focus for us today is the direction. And the direction is, of course, that we're going to be expecting some rate cuts to happen this year. Now, it's really important to kind of go over this and just in the context of how it impacts portfolio returns, right? So as you saw on the last slide, interest rates went up incredibly sharply, not just in Canada, but in the US and around the globe to combat inflation. And in fact, it's the sharpest increase in interest rates that we've ever seen, right? So what does that mean, and how does that impact stocks and bonds that you might own in a portfolio? Well, it means that stocks pull back, in part because the cost of capital is so much more expensive. So it's more difficult for companies to reinvest in their future growth. And that's essentially what markets are paying for. Markets are forward looking. And that's what, when you purchase a stock, you're hoping that that company is going to grow and the stock price will go up, right? So again, because interest rates are higher, cost of capital is higher. So that puts pressure on stock prices. So that's why you see stock prices went down in 2022 when we were seeing these rate hikes. Similarly, bonds also repriced because suddenly cash looked a lot more attractive to investors. So you have a repricing in fixed income or bond markets as well. And I should have actually just quickly went over the difference between a stock and the bond. Many people on the line are probably familiar, but just as a quick refresh, so a stock is a share or an equity ownership within a company, whereas a bond is a loan to a company or government, right? So both stocks and bonds are integral parts of building that investment portfolio for investors. And why do you want to own both stocks and bonds? Well, actually, this slide gets into that quite nicely. So generally, stocks and bonds have what we call an inverse relationship. So when you have a year where stocks are down, typically bonds, investment grade bonds, do better, right? So that helps smooth out your return profile, is having those two different types of assets within the portfolio. And that's what this slide is showing here. Now, it's really rare to have 2 years in a row where you had negative return in bonds, right? Generally, it just doesn't happen. In the 100 plus years of modern markets, we just haven't seen that. So again, I really want to emphasize what an outlier 2022 was in terms of return. So you can see the returns for bonds back in 2022, negative 13%. And this is looking at the US bond market, right? So incredibly rare that we would see 2 back-to-back years of calendar returns. So I like to say that 2022, of course, it was an outlier, and part of that is because COVID was such an outlier, right? It was that global pandemic really kind of, to be honest, just kind of messed things up for global economies and as a result for the markets as well, right? Now, if we just fast forward to some good news, so 2022 was a difficult year for stocks and bonds, but 2022 was a much better year in terms of your 1-year return. So this chart is showing the different what we call stock indexes and bond indexes around the world. So there's different ways that we can look at stocks and bonds. So of course, there's different markets, right? There's stocks that are representative of companies in Canada. There's stocks that are representative of companies in the US. And then there's bonds, similarly on the bond side, bonds that are representative of the bond markets in the US, globally, et cetera. So this here is showing you the 1 year, the 2023 return in Canadian dollars of these different buckets of securities. So I hope that makes sense. So here on the left side is what we call the S&P TSX Composite Index. That's just Canadian stocks, right? The largest stocks in Canada. So had about a 12% return last year. The next column over, the S&P 500, that is the 500 largest companies in the US. Also had a phenomenal year last year, almost 23%. Okay, next column is Europe, Asia, Far East. So consider that international, positive year. Emerging markets, also a positive year. This middle column here, the 19.5, so that's looking at globally, right? Globally, if we look at stocks as a whole, had a positive year. And then the following 5 columns are our bond indices or bond indexes. So looking at bonds within the Canadian, US, global markets, all positive with the exception of the commodities, right? Commodities didn't have a great year last year. So last year was really a tale of 2 markets. So the first half of the year, we saw a lot of volatility in anticipation of a recession. Now, did we get that recession? Well, it depends what geography you're looking at, right? So in the US, we did not get a recession. And here in Canada, arguably, you could say we're in a recession right now. Why is it so hard for us to say whether we're in or outside of a recession? Is because it's really hard to know in real time because the data is backwards looking, right? But in general, a recession is defined as 2 negative quarters of GDP. So 2 negative quarters of negative growth in the economy. And because of that, you normally would see corporate profits slow. And then as a result, there's a ripple effect, and then you would potentially see some layoffs. So again, arguably in Canada right now, we are in a recession. We've seen some layoffs here in Canada, but not in the US yet. And we'll get into why that might be in just a moment. Okay. So this next chart just shows, and this is looking at the Canadian stock index, what sectors performed well last year. And this is probably no surprise to anyone that pays attention to some financial news out there, but the stocks that took the lion's share of the return last year, or saw the lion's share of return, was information technology. So NVIDIA, anything that was levered to that AI theme. So artificial intelligence was a big buzzword last year, and a lot of companies that, again, had that AI type exposure did significantly well last year. And that was true both in Canada and the US. That was a major theme across global markets last year, was that AI theme, which was very exciting for for markets. Okay, so let's return just to more of a Canadian focused view of what is happening in Canada today, and again, how that might impact the Canadian economy and markets going forward. So this chart is showing you your job growth or unemployment situation. And right now, as you can see, unemployment is quite low in Canada, right? So as of December 2023, the unemployment rate in Canada is 5.8, and that's in comparison to a spike that we saw during the COVID period of 14.1. So we've come a long way in Canada in terms of our employment situation. We would call this a tight labor market, right? So again, as I mentioned earlier, everyone out there that wants a job theoretically can go out and get one. So this is important because as I previously mentioned, when everybody out there who wants a job can have one, this keeps wage pressure high, and that in turn keeps inflation higher, or at what we would call a more sticky inflation level. So you can think of that in the sense of, if you're going to get your car repaired, right? So it's not necessarily just the parts that you might need to repair your car that are more expensive, but the service cost of the technician who's going to be working on your car, that is what is much more expensive now, and that again is what's keeping inflation higher. So we call that the service cost. So service cost, arguably that service cost is more than that component cost in that particular example. So you can think of it in those terms. Now turning our attention to the US, the situation there is similar. We're seeing unemployment at historic lows, right? And again, same story. That means that wages have increased, which dampens that impact of higher rates. So yes, rates are higher, things are more expensive, but people are also earning more money, so they're able to absorb those inflation costs. And that is why we would say that the U.S. has been very resilient in terms of that recession being, I wouldn't want to say in recession proof, but that the U.S. has been really resilient and has so far managed to avoid falling into that recessionary environment. And I also want to just take a moment to say, on that note of recession, the most recent recessions that we have in memory for many investors and for many people out there are very extreme situations, what we would almost call black swan events. So we had the tech bubble that burst back in 2001, and then we also had the 2008 recession, which those loom large in people's memories, but those aren't typical recessions either. Also, COVID was technically a recession, very quick, short recession, also very much of an anomaly as well. So time is zooming by here. We're definitely not going to have time to get to everything, so I'll try and speed through some of these last few slides. But let's talk about, we can't talk about the Canadian economy without talking about housing, right? So housing prices have, of course, spiked here in Canada and the US. But we never saw that correction in the housing market like we saw in the US back in that 2008 environment, which you can see the little blue line dropping into 2011 and 2013 there. So housing is still very elevated in Canada and the US, but our housing market is very, very different in Canada versus the US in that here in Canada, we have 5-year mortgage terms. So that means that every 5 years you have to renew. A lot of Canadians are having to renew at a higher rate. And also in Canada, we have variable rate mortgages. So interest rates go up, and often Canadians will have to start paying more right away, right? And if they decide not to pay more right away, that just extends their amortization period. So that for us here at Fidelity makes us quite concerned about the Canadian economy and the Canadian consumer going forward versus our US counterparts, because again, in the US, they've locked in those 30-year fixed rate mortgage terms. So they're less impacted by those rate hikes versus here in Canada, where our consumer is having to pay more for their housing costs, which means that they're going to be paying less on discretionary spending. So We have a lot more indebtedness in Canada as well, so household balance sheets did not go through that same rebalancing like we saw in the US as well. So that makes us, again, more concerned in Canada. As well, we're seeing a drawdown in savings both in the US and Canada. So there's a lot of pent-up savings that happened during COVID, and we're seeing that kind of roll off now as well. So again, less disposable income for Canadians. Okay, so just quickly on oil, overall, and this is going to be super quick, but overall we're cautious with regards to oil prices, and that's in regards to the cuts that we've seen from OPEC. So we are seeing weakening demand and also potential geopolitical impacts that are affecting prices. So again, that just makes us more cautious on the oil and commodity picture overall. Now, turning our attention globally. So we do expect to see slower growth in Canada and the US in the coming years. We expect to see inflation continue to slow. Supply chains, that supply chain bottleneck that we saw during COVID, that for the most part has been resolved. Right, so we're hearing less complaints from companies. Operations are much smoother in terms of the supply chain disruption. So that problem is effectively solved. You do hear some things about the Red Sea right now and the impact on supply chains there, but that could actually interestingly benefit companies like Canadian National Railways on the margin as they are approached to maybe transport goods from one port in Canada to another. So another thing that's going to be impacting growth globally is aging populations, right? So in a lot of developed countries, you see that slowing, that slowing in population growth. We have a lot more people in our again G7, so developed economies, that are approaching retirement, and that means that when you have people that are out of the labor market, that are no longer working, they're less productive, and that hampers growth over the long term. So that's something to consider as well. Turning now to, again, more globally, kind of where we see things. So this chart, just to explain really quickly, is what we call the business cycle. So the economy just tends to go through four very different distinct phases. And it just rinse, repeat, rinse, repeat. So early cycle is typically characterized by a growth in the economy. You see profits growing, policy is stimulative, et cetera, et cetera. Then we have mid-cycle of the economic cycle, and that's where you see growth peaking, profit growth peaking, more neutral monetary policy. You start to see inventories and sales grow. And then we have late cycle, which is where we are now. Right, so that's where you start to see growth moderating, credit tightening, so you start to see maybe interest rates go up, earnings become under pressure, and then we fall into recessionary environment, right? So that's where you see, again, that's really slowing growth, falling activity, credit dries up, inventories and sales fall, etc. So currently we're in late cycle, and everyone's kind of waiting for that recessionary environment to hit. So far, the US has managed to avoid recession. Canada likely in recession, as we're more vulnerable to that higher interest rate environment. So we do expect, earnings to still be positive at the moment. So corporate earnings to remain strong, but maybe lower growth than we saw earlier last year. So that is a super quick whirlwind. I want to make sure we have some time to get to other parts of the presentation. We're going to revisit with some questions after, but maybe I'll just cycle through some of the costs of emotional investing. And we're actually going to return to this one afterwards, so I will just skip it for now. Okay. So one thing I really want to highlight is that, despite the increase that we're seeing in things like geopolitical risk, the turbulence that we've seen in markets, For the most part, 2/3 of the time markets are up more than they, 2/3 of the time markets are positive, right? So markets are up more than they're down. That's why you see that over time, if you're looking at any market, be it Canadian stocks, US stocks, bond markets, etc., the line goes up and to the right, right? So sure, there's turbulence, sure there are headlines, but ultimately the market has continued to increase, to grow over time. And the reason I point to this slide is because you never know when those positive days in the market are going to happen, right? So you can have a surprise to the upside where markets have a positive day and maybe 1% return. And the cost of missing those positive days in the market can really impact your investment return over time, right? So this chart is just illustrating why you want to stay invested through despite the headlines that you see, because I'm going to jump ahead here. There's always going to be something to worry about with respect to headlines, right? So in last year, you can talk about inflation, the rise of interest rates, tightening monetary policy. In 2020, we can talk about the COVID pandemic. 2003, we're going back to the war in Iraq. You're always going to find a reason not to invest, right? If you're looking for it, you're going to find it. But markets are up more than they're down. So on the right side, these are calendar years where the markets were positive, and on the left side is years where markets are negative. And this bottom bar is showing you the percent, that in percentage terms, right? So in general, you can see more boxes stacked up on the right-hand side. Markets are positive more often than not. So there's always going to be a reason to worry, but it's incredibly important to stay the course, to stay invested. And I also like to highlight this slide here. And this is looking at the Canadian stock market. So the blue bar is showing you the end of year return for the market. So again, most of the time since 1986, Canadian stock market has ended on a positive note. But the green dot illustrates the intra-year decline in markets. So that is, in last year, for example, we saw at one point the Canadian market was down 10%. But we still ended on a positive note, right? That's the last bar on the right-hand side. So again, you can see volatility and chop in markets. That's an inherent part of investing. But that doesn't mean it's going to stay down there, right? That's the importance of staying invested. And again, like I mentioned, if you look and you focus on the big picture, all these bars, these lines represent different types of assets. So Canadian stocks, US stocks, small US companies, et cetera, and so on. And you can see that over time, they all go up and to the right, right? Despite these headlines here that might prevent you from investing. So I think that it's always worth to highlight that. And in particular, why having a supportive financial advisor is so important is that they can help guide you through these turbulent times, which are inevitable, which are going to happen. There's no escaping it. Again, volatility is an inherent part of investing. And we believe in the value of advice here at Fidelity. And we know through independent research as well that working with a financial advisor can help create up to 2.5 times, almost 2.5 times more wealth. And that is in part because advisors can help with so many different aspects of financial planning, but they can also help keep you grounded, keep you invested, in addition to tax planning, estate planning, financial planning, all that other stuff that advisors do that help you compound and grow your money over time. And as an illustration, this last one, and then we'll turn it over for Q&A because I've gone on too long and I think I'm over my time by a couple minutes here. But this is showing you the power of compounding. And we're illustrating this with two different investors here. So John, he starts in year 1 and he contributes for 10 years. But in total, he's invested for 20, right? So he basically starts investing every year. He adds money, maybe during his RSP for his RSP contribution or with his TFSA. And then at year 10, he stops investing and he just lets the money ride, right? Susan, on the other hand, Susan here contributes for, she starts when John stops investing, so to speak, and she invests for 10 years for a total contribution amount of $100,000. So she actually put in more money than John over here, who only ended up putting in $50,000. But at the end of that time period, so at the end of her 10 years, at the same rate of return, right, an average annualized return of 8%, she's left with $156,000, whereas John, who again invested half that amount, but for double the amount of time, had $168,000. So he came out ahead having contributed less money. And I think this just illustrates that it's not about timing the market, right? It's not about the, trying to time it perfectly, waiting for this event to happen. Okay, waiting for the stock price to drop and I'm going to invest in now. But what's more important is your time actually spent in the market than trying to time the perfect time to get into the market is what's really, really important here. So I know that was a bit of a whirlwind. We ran through a lot in a very short period of time. I went over by several minutes, but I'm going to hand it back to Jackie to see if there's any Q&As that we can get to here in these last 10 minutes or so.
Thank you, Jamie. That was lots of great information, and I think you did a great job in that amount of time. So. One question that I would like to ask you is, we get asked all the time right now with high interest rates, is why would we get into the market instead of just buying a GIC guaranteed for, a year at the rates they're at today?
Yeah, great question. So here, I'll share my screen again. Here is a chart. So there's a few different reasons. So I'll let you all stare at the screen while I talk. So GICs, yes, it's true. Rates have come up. They look a lot more attractive than they have in the last 20 years, right? However, the time to invest in GICs was realistically back in 2022, right? Now we're seeing a more normalized market. And if you're looking at in terms of your opportunity set, so there's a few different setbacks with regards to GICs. So one is you're locking up your money for a year. So the problem with that is that in a year like last year, when markets performed really well, your opportunity set is much greater within the market. And if you're locked up in a GIC, you don't have the ability to take advantage of that. So yeah, GIC rates, maybe if you found a good one last year, you could have gotten maybe, let's say, about 6%. Markets in like a low medium risk balance fund, again, a wider opportunity set, investing globally. So you could have returned double that, right? So that's one of the main reasons why you want to, if you have the capacity for, if you have some risk appetite, if you have a longer time horizon than, let's say, 2 to 3 years, you have a wider opportunity set and more potential for return in a investment that considers that bigger, those different markets, right? Stocks, bonds, globally, etc. So that's one thing. You're locking your money up for a year. You don't have the chance to participate in markets like we saw last year. And then another thing you have to consider with GICs, two more things to consider, is that the reinvestment risk that you have, right? So, okay, maybe your interest rate today is 5%. In a year from now, what's your interest rate? Because we talked about how interest rates are going to go down, right? So okay, in a year from now, maybe I'm only going to get 4%, right? Again, in the market, maybe you could have gotten a little bit more, right? Providing that you have that risk capacity and time horizon. Another risk that people don't talk about with GICs is inflation, which is what I'm showing here, right? So inflation has, yes, GICs rates have been elevated, but so has inflation. So your return is actually on a real basis when you take your return and subtract inflation has been, it's slightly positive now, but it was actually negative. That's the blue line. That's what that blue line is showing you here. So slightly positive now because inflation has come down. But, you know, if we keep inflation around 3% and your GIC rate is 4%, really your return is actually only 1%. That's not a very attractive risk return considering that lockup period that's there. Another risk with a GIC that isn't talked about is taxation. Where are you holding that that GIC? Are you holding it within a tax sheltered account? If so, okay, that could make sense. But if you're holding it in a non-registered or just within a regular bank account, there's a taxation component there that can start to be quite significant when you start talking about tens of thousands of dollars in a GIC. So to summarize, some of the problems with GICs is you're really constraining yourself in terms of your opportunity set because you're locking up your money for a period of time. You also have reinvestment risk that you have to consider. You have inflation risk that you have to consider. Also, what if inflation reaccelerates, right? And then you also have taxation that you have to consider. So GICs seem safe, but there's a lot of other nuance to it that should be considered as well.
Perfect. Yeah, thank you for that. One other thing I just want to touch on with Fidelity, as I know I do get emails, is what is Fidelity's take on the Questrade ads that are out there that we all see as we're watching our news or watching our shows and our sports on TV?
Yeah, I think that I'm so glad you asked that question. Those commercials are, to be honest, they're quite misleading. So Questrade really emphasizes that the most important thing is your fee, right? So all else being equal, yes, fee is an important consideration, right? But not all else is equal, right? So if you also again have to consider things like taxation. You have to consider that what other services are you getting with this particular product, right? So if you go invest with Questrade, you buy one of their Quest Wealth portfolios, for example, but are you getting any tax planning? Are you getting any financial planning? Are you getting any estate planning? Are you getting anyone to call if markets go down and you get worried about something? Or what if you have a life change situation, right? You know, a parent dies or you have to step in and take care of a loved one, unexpected costs, right? Who do you reach out to with Questrade? So financial advisors, yes, you're paying a fee, but you have to also think like you're paying for that financial advice and for having someone support you in terms of the planning aspect. But now let's talk product as well, because again, fee is an important consideration, but it shouldn't be the only consideration. So there's products out there that do better than the Quest Wealth portfolios. Fidelity has some of those products. Ask Jackie about them. So, you know, maybe our fees we have products that are very comparable to the Quest Wealth portfolios, but you want to think about, you know, maybe Fidelity's portfolios are a little bit more expensive, but if we're returning more on a net basis and you're getting financial advice, like, isn't that worth it? Like, if you have more money in your pocket and you've got someone to call who can help you with financial problems, that to me is like a win-win. So the Questrade commercials are really misleading, and they only want you to consider a very narrow aspect, and they don't consider all the other nuance that comes to your financial picture.
Exactly. No, thank you for touching on that, because it's always, yeah, watching those commercials is a bit tough sometimes. So, Jamie, on behalf of my team here at Northern Savings, I just want to take the time to thank you for your time today, and teaching us all a little bit about, you know, investment markets and what to expect in 2024. And if you have any questions for myself and my team, please do not hesitate to reach out. We are more than happy to have discussions and conversations with you regarding your financial matters. And thank you, everybody, for coming to our webinar today, and we look forward to seeing you soon.
Thanks for having me. Thanks, everyone.
Thanks, Jamie.